China has faced massive headwinds as financial stability has become a major risk factor. The IMF has pointed directly at some of their issues and made some weak recommendations. Unlike countries like Greece, the IMF doesn't have control over their monetary system, so they tread lightly. In times of crisis, however, the supranational entities suddenly gain oversight and discretion in places they should never be. You came here for the truth, so let me unveil that for you. Today we are going to have our focus on China. Let's begin. Looking at this article out of Bloomberg, China's banks should increase their capital buffers to protect against any sudden economic downturn following a credit boom. That's according to the IMF. And they always make recommendations for different countries around the world. And I will show you how they identify the problems very correctly. If you read the IMF reports, I tend to agree with everything they say. But then they make solutions that are just wild and crazy, and they will never work to fix the problem. But of course, that's not what they're trying to do. In the first comprehensive assessment of China's financial system since 2011, the IMF recommended a gradual and targeted increase in bank capital. In a worst-case scenario, the IMF's test suggested that the country's lenders would face a capital shortfall of equivalent to 2.5% of the GDP. That's nothing. I mean, that's the worst-case scenario. But that's not really what we are talking about here. A 2.5%, even during the financial crisis, which apparently was a US problem of subprime lenders, subprime borrowers all going bust. Somehow that affected the global economy, not 2.5%. So the numbers are definitely off here. Overall, 27 of the 33 banks stress tested by the fund, covering about 3/4 of China's banking system assets, were undercapitalized by at least one measure. So at least we're identifying the fact that a lot of these different financial companies are not dealing with their business properly. They need more capital underneath all of those fraudulent investments that sit on top. A larger cushion would be a better reflect, the risks. Okay, moving on to the chart. China's debt is at risk exceeds the average for large emerging markets. So you compare this to others here where, it's Mexico and Russia, but China being higher. Now, obviously, they have a lot more business going on there. It is a rather big economy, and there are, big changes that are happening within China today and will emerge over the next few decades. I think there are a lot of concerns that are there, and they're understated, in fact, by the IMF. Noting a lack of coordination and inadequate systemic risk analysis in a report, the IMF also recommended the formation of a financial stability subcommittee, comprising, check this out, the central bank and 3 regulatory agencies. So if we look at this from the US, right, you have the central bank, which is totally in control of everything, and the regulatory agencies. They're all complicit with the overall design of how this system works. Look at the SEC, consistently being found out that they are on the inside. We knew all the fraud, they never expose it. Until, of course, it's way too late. You look at all the rating agencies, which rate garbage products at AAA, you know where I'm going with this. And they're talking here about wealth management products. So let's quickly go over that. Since the IMF's last assessment of the Chinese financial system in 2011, 2 concerns remain. Credit growth remains high, and the expansion of wealth management products. Those are 2 issues. I'll show you here in a chart form. But let's look at this. Whenever the IMF, as I said earlier, they address the scenario correctly. There's risks here. These are what the risks are. They've identified them perfectly. But then they create recommendations. Create a body focused solely on financial stability to improve oversight of systemic risk. Okay, that's not going to do anything because there are already bodies in place. Financial supervisors need to have greater independence to pursue their mandates without concern of being overruled. Banks should hold more liquid assets. Finally, some good suggestions. Reforms to reduce the reliance on public funds, and it goes on, okay? They don't make any strong suggestions to how about you stop getting into derivative products? How about you actually get the public to move away from the rural areas into the cities, create businesses, create jobs, reduce regulations, and have the system grow naturally. But that's not what happens. The government wants to control anything, and that goes for China, that goes for the US, the UK, Australia, Canada, and everywhere else. They always want to have control. I don't care what type of government you believe that one has or the other. It doesn't matter to me. All I care about is the fact that there is more and more liberty for these individual countries, and that means the people within them. WMPs, all right? The previous article, look at this. Since the financial crisis, wealth management products have escalated to new heights. Now, we should have seen some concern. We should have had some restraint after all of this. But no, of course not. Of course not. These have increased to the tune of nearly 30 trillion yuan. We're talking trillions of dollars that has been expanded greatly within China. I've done videos about this before. I won't expand on it now, but this is one of the problems that are being highlighted by the analysts right now. And then quickly this. So there's a timeline here. I don't want to cover it all, but essentially what we're looking at is a danger level, the red line here, which has been crossed significantly beyond that. And as it shows right here in the top corner, that's only 2016 numbers. Back in 1998, China issued special bonds to recapitalize the banks. I always found this interesting, particularly when we saw the crisis unraveling in Europe, where they said, we need to restructure the debt. That was something that I just kept hearing over and over again. So I looked into what they were suggesting, and essentially they're just moving around garbage in a dump. That's what they're doing. You have a dump where everyone unloads their garbage, and you decide to reorganize the place. That's what it is. And it's truly, truly frightening to see that reorganizing the debt, restructuring it, is somehow a solution to any problem. And then you sell it off as an asset? That doesn't even make any sense. The whole point of this product that existed, it failed. And now you're going to sell it as a product because you repackaged it? Truly insane. And people are buying into this. And if you don't think you're buying into it, understand that the pension funds have got into this. You're looking at different mutual funds that have been getting into this, hedge funds. You're looking at all markets which are interconnected to the ones you invest in, one way or shape or form. Maybe you personally don't, but somehow maybe your wealth, maybe the corporation you work for is investing in it, so you could lose your job if they go under. You have to understand the ripple effect, right? And so, just to finish it off here, bank analyst, this individual said China has the biggest debt bubble that the world has ever seen. I don't know what we're going to make of this, but the central bank, the People's Bank of China, needs to get the printing presses warmed up. If you found this video informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can flip through these books. If you go over to Amazon, they have a look inside feature. It's going to allow you to flip through the pages of these books to see if you like them. Take care.